Most billionaires chase speed. Warren Buffett chased time. In a world obsessed with disruption, he built an empire by doing the opposite of everyone else. He waited. Here's the uncomfortable truth. Warren Buffett became one of the richest men in history by ignoring most opportunities. Most people won't comment. If this surprised you, type what shocked you the most. Like it so this story doesn't die here. Subscribe because the next one will hit even harder. While Wall Street traded constantly, Buffett often did nothing. No hype, no noise, no rush. And that's where the real story begins. In the 1960s, Berkshire Hathaway was a failing textile company. Cheap overseas competition was crushing American mills. Margins were collapsing. The industry was dying. Most investors ran away. Buffett bought it. At first, it looked like a mistake. Textiles had no future. But Buffett wasn't buying textiles. He was buying control. He turned Berkshire into a holding company and began acquiring insurance businesses. And this is where the secret starts to reveal itself. Insurance companies collect premiums upfront and pay claims later. That gap creates something called float. Imagine billions of dollars just sitting temporarily in your hands. Buffett realized float was better than debt. It was capital he could invest before paying it out. If managed correctly, it was almost free money. This transformed Berkshire into a capital engine. But access to money wasn't the real advantage. Discipline was. Buffett follows a simple rule. Only invest in businesses you understand. Coca-Cola, American Express, Apple. Not because they were trendy, but because they had durable advantages. Brand power, customer loyalty, pricing strength. He calls it a moat. Just like a castle protects itself with water, great businesses protect profits with competitive advantages. Strong brands, network effects, cost leadership, switching barriers. Buffett doesn't chase growth, he chases certainty. He looks for companies that can raise prices without losing customers, companies that generate consistent cash, companies that survive recessions. And then he waits. Not months, decades. While others panic during crashes, Buffett buys. During the 2008 financial crisis, when fear dominated markets, he invested billions into companies like Goldman Sachs and Bank of America. When others saw collapse, he saw leverage. Here's the deeper strategy. Buffett is not predicting the future. He's preparing for human behavior. Markets are emotional. People panic. People get greedy. Buffett remains rational. He once said, "Be fearful when others are greedy, and greedy when others are fearful." That isn't motivational advice. It's a power strategy. When panic drives prices below intrinsic value, he moves. When hype inflates prices beyond reality, he waits. And then there's his final secret. Compounding. Buffett started investing as a child. He understood that money grows exponentially over time. A 20% annual return, sustained for decades, becomes unimaginable wealth. The real magic wasn't stock picking, it was time. Most people want quick wins, but Buffett built systems. He avoided unnecessary risk. He avoided debt. He avoided businesses he didn't understand. He said no more than he said yes. And over decades, those disciplined decisions compounded into one of the greatest fortunes in history. The lesson isn't just about investing. Most people won't comment. If this surprised you, type what shocked you the most. Like it so this story doesn't die here. Subscribe, because the next one will hit even harder. It's about thinking long-term in a short-term world. It's about patience in an impatient market. It's about clarity when others are emotional. Warren Buffett's real advantage was never secret formulas. It was temperament. So here's the question. If the world rewards speed, hype, and constant action, do you have the patience to win by standing still?